Good afternoon, but also, good morning or good evening to everyone online. And I'm Carmine Di Noi. I'm the Director for Financial Enterprise Affairs at the OECD, and it's my great pleasure to welcome you to this webinar for the launch of the report on managing government cash. And so, thank you for joining. And we have a distinguished panel of speakers, experts in this field, and so we'll introduce them shortly. And we also have a packed agenda, which I'm keen to get into as soon as possible. First, I want to say a few words about the report that we are launching today. Let me start by giving a brief overview of what today's webinar is about. So cash management is crucial for governments as it ensures the efficient handling of public funds, so enabling governments to meet their financial obligations. And it also plays in role in the liquidity of the wider financial system, and more importantly also in recent times. Now, while public debt management is a topic well known and covered across policy communities, especially here at the OECD, now cash management remains a bit undercover, less visible, and policies and practices actually they vary very widely across OECD countries. And at the same time, technological advances, shifts in financial markets, and expanded government cash operations have transformed cash management in recent decades. Now, and we had important changes and episodes that made it even more and more important. The COVID-19 pandemic serves, unfortunately, as a prime example of the need for having more agile systems so that governments can meet unexpected and big unexpected funding demands. Cash balances also among G7 countries basically increased from around $1 trillion actually in total at the start of 2020 to almost triple, so $3 trillion at the height of the pandemic. And this increase reflected the sudden changes in funding requirement amid uncertainty about the precise also fiscal impact of lockdown measures. Now, so recognizing these trends, the OECD has prepared this report with a substantive input of the experts, cash management practitioners, some of whom we are about to meet. Now, the analysis looks at diverse country approaches and offers some practical insights for policymakers. The report provides the first, is safe to say, in-depth overview and analysis of the cash management practices in OECD countries. So it's an important milestone for us and for all of us. So while the goal for cash management is universal, so ensuring governments meet their payment obligations, approaches, as I mentioned, very widely, and so information on leading country practices is scarce. We know that transparency is the best of disinfectants, so we want to contribute to shed more light on this. And I think the report can be a good way to fill this gap. The analysis in terms of process is being published under the auspices of the OECD Working Party on Debt Management, which is a group of senior debt management officials from OECD, super senior, I would say, debt management officials from OECD member countries. Now, following a proposal at the 2023 OECD Global Forum on Public Debt Management, the Working Party established an ad hoc group on cash management. The aim of this group was to exchange member experiences and practices and knowledge, so facilitate peer learning. The group consists of delegates from 22 OECD and OECD accession countries with specific experience in or responsibility for cash management. It operated with the support of the OECD Secretariat for approximately 12 months, so between November 23 and November 24. The insights shared by the group through a series of meetings and documents are captured in the report. And this includes peer learning exchanges through virtual and in-person meetings that were in Dublin in April 2024 and Paris in June. And I would like to really express my sincere thanks to all those group members who gave their time and the food for thought, so share their expertise to make the report possible. The group was chaired by Anthony Linehan, Vice Chair of the Working Party on Debt Management, who is here, and Deputy Director of Island Funding and Debt Management in the National Treasury Management Agency. And we'll hand over to Anthony in a few moments to present the main funding of the report. Now, after Anthony's presentation, we will have, in terms of structure, a panel discussion, which I will have the great pleasure of moderating. The panelists, and they are online here, you see them, are Davide Iacovoni, is Director General of Public Debt from the Italian Ministry of Economy and Finance, Joe Whelan, Deputy Chief Executive and Co-Head of Policy and Markets at the UK Debt Management Office, and also welcome to you, and Alexander Bonnyman, Director of Debt Management at the Department of Finance in Canada. So welcome to all of you. I see you on screen. So with that, I hand over to Anthony to present the key findings of the report. Anthony, please, the floor is yours.
Thank you very much, Carmine. By nature, this will have to be a relatively high-level summary of the report, and there's a lot more detail and rich findings in the report itself. If we could put the presentation up. Yeah, thank you. And go to the next slide. Carmine has already covered much of what I wanted to say here. But apart from the cyclical events of recent times, I think the other one worth calling out is monetary policy changes that have affected cash management for everyone. But also structural changes in the market involving technological advancements and developments in financial markets themselves. When the group met, the first thing we did was actually openly put in a series of questions on cash management and all the things we wished ourselves to understand. If you go to the next slide, you will see that it naturally fell then into three natural groups. The first question was cash flow forecasting. How good are we at forecasting cash and our cash needs? And how much do we need to have cash? And what is our attitude? And how do we finance this? The second area was one then of policy. Do we have deliberate policies to have cash and cash balances? And the third area was that if we have cash or need for short-term cash, what instruments do we use? And what is available to us as debt managers? And these therefore naturally formed the chapters, the main chapters in the report. And I shall now go through all three. Starting with cash flow forecasting. Next slide, please. And the slide after. I promise this is the most complex slide I will produce today. If you actually start at the bottom left corner, this is the one that debt offices understand best, which is the financial sources. We know when debts will mature, we will know what debt we are raising, what day it will be paid. So that flows, those flows, financial flows, are very well known in debt offices and can be easily managed and forecast. It's on the fiscal side that the problems can arise. And this is not because of any difficulty with the fiscal agents, it's because of the unknowns. We set out budgets every year, but we don't really know how the economy will grow. Sometimes it can surprise us on the upside, and sometimes it surprises us on the downside. Broadly, the budget will be reviewed maybe once during the year, and so we will get to annual forecasts. And these really, as we said, long-term forecasts lead to the debt management strategy. The issue is more when we break down those budget numbers into quarterly forecasts or then monthly forecasts and say, when will payments actually be made? Things that change, like social welfare payments, if there's higher or lower unemployment, will trend over time. But there can be significant one-off payments. And then we have to decide, will these come, which month do they come into, and they get broken down. But it gets even more difficult when you decide what day those payments will be made, or what, more importantly, what day will certain tax receipts be paid. Tax affairs are normally quite private in any country, so the debt office would not have from the tax authorities the tax affairs of large corporates or that, or know exactly what size the corporate tax payment will be. So all these need adjustments. And so cash planning consists of both the annual forecasts, usually just once a year, medium-term forecasts, monthly ones, but then the daily ones. And it's those daily forecasts that get adjusted quite frequently, daily or even twice a day, as we see flows coming in and out. To decide how we manage this, most decisions are made within the green area, the debt management office itself, and integral to debt, but some do have committees on cash management, and some indeed have an ability to postpone payments. But most debt offices use cash instruments to manage those flows, a mismatch of timing where revenue and receipts come at revenue or outflows occur at slightly different times. If we go to the next slide, we can see here some of the practices that occur. Everyone, I think, models their debt. And some have to use statistical models, but everyone models both from past practice and past experience of cash flows to see what is likely to happen, what is the likely patterns to be. There's increasing automation, though still a lot can be done in Excel spreadsheets, trying to manage and forecast what will happen over the next week or two as various flows take place. As I said, we can be fairly accurate on the year, or it slowly evolves. The accuracy on the short-term forecast is really what the cash team are looking at in terms of, has the flow been received, or if not, will it be in the next few days, and adjusting daily as each flow is seen in and out. And ex-ante checks are widespread and embedded in the forecast policy by all DMOs. Turning next to the whole issue of liquidity risk then and the policy. The core for everyone and the fundamental rule of all debt offices is that there be enough cash to make sure all payments are made. No one will ever miss a payment as government agencies. It is not acceptable. But there can also be secondary objectives, and we give some examples here. For instance, in the US, there's explicit plans for potential market disruption, such as natural disaster or cyber attacks. And increasingly, most countries would have some element of that to be ready if there was to be a disruption. COVID was the probably greatest disruption, as we said, of them all. Also, if you have your own currency, like the UK, you would be concerned, and they are, that the actions of cash management does not conflict with the Bank of England's monetary policy effectiveness. This is often seen in countries where they have their own currency and their central bank policy. And then elsewhere, such as in Europe, where the central bank does not remunerate government deposits at market rates, there is can be an aim to maximize the return on any cash the DMO holds while taking into account risk. These are secondary aims, objectives, having achieved the first. Liquidity policies themselves have been quite explicit. I suppose one thing that became clear is they tend generally not to be published, though there are limited public documents with regard to how cash is managed. But within those policies, there's usually liquidity indicators, policies with regard to counterparty risk, etc., if you have surplus cash, and tools that will be acceptable for borrowing, and different periods for which different cash might be needed. I will talk about this again in a second, but also issues like pre-funding of maturities. If you go to the next slide, we come to the area that probably had one of the greatest debates among us, and it actually was partly because terminologies can be quite different. Some countries use the word cash liquidity buffer, where others mean a cash buffer, and vice versa. So for the purposes of this report, we define the cash buffer as the minimum cash a country decides to have to make sure they can always manage any short-term fluctuations between receipts and outflows. This cash buffer is nearly always held at the central treasury account at the central bank. A liquidity buffer, however, is where countries decide that on top of that, they want to have a buffer for various reasons. This, as I said, can be to pre-fund maturities or because they want to be ready for extreme eventualities. Liquidity can have wider definitions of what is constituted. So, for example, liquid cash instruments that can quickly be liquidated will count as liquidity buffer for many. Foreign currency deposits, especially for those who might have foreign currency debt, will be part of their liquidity buffer. But also some countries would regard, if they have deep capital markets available to them and they can easily borrow money, then market access itself will also be regarded as part of their liquidity buffer. If we go to the next slide, I'll just look now quickly at the different types of cash instruments that countries use. The obvious one is treasury bills. This is well known. It's a market that is quite big, quite depth, and has a good secondary market. And it's a very good tool to use where you want to keep a buffer of cash. You know the buffer you want to keep, because the one thing with T-bills is that market generally looks for regular issuance and defined issuance. Therefore, they're not the ideal tool where sudden cash is required and you need to deal with a short-term mismatch. They're more for your long-term liquidity buffer. Cash management bills are somewhat similar and indeed can be fungible, but they are more ad hoc issuance to deal with those very sudden cash requirements that may be necessary. Where countries have large cash surpluses unexpectedly due to fiscal outturns being different to what expected, buybacks or bonds or bills can also be considered. They have the benefit of reducing the stock of debt, but they also can be poor value for money, and they do affect the liquidities of bonds or T-bills that are outstanding. One that has become more common of recent times is use of the repo market and reverse repo. Here, it again is of most benefit to those countries that have a deep capital market around them and can therefore have access to large repo market. But there it can be very useful, both in terms of issuing debt in repo to raise cash for a few days if needed, or alternatively investing cash in the repo market. But it can be costly at times of uncertainty. Commercial paper was another tool used by some countries. Again, it has, unlike T-bills, it's ad hoc. It can be issued when required and offered to the market to maturities that suit the issuer. It's a bit more documentation involved in that tool. And lastly, there's the issue of just taking short-term loans. Again, that can be done between debt offices, in fact, between countries where they're in a common currency or even across currencies. But also, it can be done in the market. But given the size usually of DMO's requirements, it's important, felt in general, that such loans do not distort local markets. And again, this comes back to the size of the local market and the impact the sovereign cash management can have on that market. Lastly, just one slide here to give a kind of graphic idea of how these might be used. If you look at the size of the buffer, for people who have a very large cash buffer, they tend to use more tools than obviously those who don't. And if they have a limited market access, it becomes more important. The more common, I suppose, midpoint would be the combination of T-bills and shorter-term money market instruments. And then for those who have a low buffer but have high access to markets, use of short-term capital repos, etc., can easily satisfy their needs for short-term cash. Investing is slightly different. Countries are conscious it's taxpayers' money, and therefore the counterparty risk is very, very important. There's a tendency, if you can get a market return from your central bank, then the surplus is nearly entirely placed in the central bank as the most secure way of investing the money. But otherwise, as you go along and level of market access, people will look at other ways of investing that money in short-term market instruments and in other deposits and the kind of tools I mentioned earlier to maximize the return on that cash that the country has. So that is a very high-level view. I think I have no more slides. No, just my concluding remarks to say, look, it differs between countries depending on the size of the country, the size of the capital markets they work in, their arrangement with the central bank, the risk appetite of the debt office itself, but also the issue of the rating of the country. That is also an important factor when it comes to market access. I suppose the key thing that's common to everyone is the need for flexibility in cash management, so as to be able to manage sudden funding requirements and mismatches as they arise. So I will leave it there and hand it back to you, Carmen, for the discussion.
Thank you. Thank you very much, Anthony, for really excellent overview of the report, which obviously it's very rich in details, and really encourage all of you to read with all the the different cases. So let's move to the panel discussion, and so we can go also be to be more granular and go in the specifics. And I'm sure that David, Joe, and Alex will be able to provide a bit more. Also, we can go in specific and country experiences, which can be really relevant for all also those who are attending. So, and now maybe let's start with a general question to the three of you. One important issue is that we have seen all the different experiences, and so the importance of country-specific also conditions in cash management. And so we understand, and that it was implicit that the one-size-fits-all approach is really not valid here. So with this in mind, maybe could you tell us a little bit, more about how your country-specific cash management function also has evolved over time, maybe also due to the evolution of the debt, and also what are the key events also that have shaped these changes, and what are maybe the advantages in this evolution of, let's say, the current setup, and also what are the challenges. Maybe let's start with Davide. Davide, you're muted, still muted.
Sorry, can you hear me now?
Yes, perfect.
Okay, thank you very much. First of all, I would like to thank you and in general the OECD for inviting Italy to this very interesting and important, in my opinion, presentation. And I also would like to thank the OECD Secretariat and in general the Working Party on Debt Management for having involved us in this project. That was very demanding, actually, in terms of work, but was really useful because it offered, I think, a unique opportunity to exchange experiences with the other countries, like Anthony was saying before. And also, let me tell you, it's always a way to go deep into an analysis of our current framework of cash management in order to better understand the cons and the pros and the areas for improvement. So really happy for that. And I think the results have been extremely successful. Now, let's go to your question, Carmine. So up to 2010, more or less, our cash management in Italy was quite basic, I would say. So we had to fulfill a minimum threshold for our cash balance at the National Central Bank at the end of each month. And of course, on a daily basis, this balance could not be negative. Otherwise, this would have blocked the state and local authorities' payments. Now, to reduce this risk basically to zero, the cash buffers were kept quite high and beyond all the other debt instruments were used to keep this cash buffer high. So beyond our ordinary bond issuance, T-bills were crucial because they allow for, having a stable, regular pattern of bond issuance activity on one side and cope with the volatility of our primary cash balance on the treasury account on the other side. And so the treasury bills were kind of the middle, trying to offset and compensate for these difference, considering also that outflows and inflows on the treasury account depends on a very large number of public entities that are operating on this account. Now, from 2010, there were quite a number of changes, mainly due to the action of the ECB that at that time was asking all member states to be able to forecast their cash balance at the national central banks for a given time horizon. Normally it was 30 days. So in this way, the ECB was trying to improve its monitoring of the Eurosystem liquidity through the government deposits. Now, because of that, we had to set quite a complex institutional mechanism to be able to monitor and somehow forecast the evolution of primary treasury inflows and outflows. And this was carried out thanks to a collaboration of the main entities that are in charge of this monitoring, which is the accounting department of the Ministry of Economy and Finance, the Ragioneria Generale dello Stato, and the Bank of Italy, so the National Central Bank itself. It was not easy because it's not easy to forecast a treasury account evolution that is made of a very large number of entities that are involved, where there are a lot of seasonal trends. There are possible large swings in tax revenues and the evolution on the economic side. So it was not an easy task to put in place, but over the years, this has improved quite a lot. Then in addition to that, we introduced also treasury daily auctions, liquidity auctions, that we called OPTES, that were made to raise or invest cash overnight in order to achieve the targets in terms of balance, the treasury account that we have previously communicated to the National Central Bank. So the National Central Bank knew at that time what were our balance targets, and just in case we were short of these targets, we can use these treasury liquidity auctions to raise or invest the money overnight. But I have to say that in practice, from 2010, when we started this up to 2018, so, most of these auctions were in investing in the market our excess cash. So we were keeping the treasury cash balance quite high, and all the difference in terms of reaching the targets were accomplished by using these treasury daily auctions when investing cash in the market. Moreover, we also introduced the facility of bilateral deposits, where we could invest the most stable part of our excess cash with some counterparts, and in some cases also raise cash. So in this way, we could also address the incentive that were set up at that time by the ECB to keep part of the money out of the National Central Bank, and improve in this way the efficiency of our cash management, because the remuneration of the money kept at the central bank was lower, or in any case was limited, whereas if you get out in the market, you can get a better remuneration. Of course, to lend the money in the market, we had to set up also a counterpart risk framework that since then has undergone several revisions. Now, with the QE, with lower interest rates and with ample liquidity that we had since 2014, 2015, in these daily auctions were basically went desert for many cases. And so we decided to stop them because, of course, there was such an ample liquidity in the market was not interested in our offer of liquidity in addition to that. So in the period between 2019 and 2021, we were using just bilateral deposits to manage our excess cash that in any case, for prudential reasons, we used to keep quite high. Now, with the COVID crisis, we really jumped into a new setup for our cash management. In May 2021, we entered actually in the repo market. We used the regulated electronic platform on a multilateral basis that I have to say improved massively our capacity or ability to raise with the repo contracts and to invest excess cash with reverse repo. And so these were all collateralized contracts that were based on the huge amount of liquidity that characterized the Italian repo market. So together with the private market participants, we entered into this market, and we adhered to the market other participants together with the rest of the market. At the same time, in 2022, we entered into several trading venues also to trade the uncollateralized deposits, to invest and raise cash. And this happened on top of our off-the-counter OTC deposit transaction. Now, in this new context, of course, the need to keep high cash balance was significantly reduced, and the T-bills gradually lost some of the roles as a funding tool to absorb the volatility of our primary treasury account flows. As I was saying before, we managed to have T-bills issued in a way to respond more to the evolution of rates, to evolution of demand, and less to the strict needs of cash management. And finally, in 2023, we also introduced one-day reverse repo, which brought much further flexibility in our cash management. So right now, our cash management activity, I would say, is quite developed. It needs further improvements, of course, and that's what we are working on right now. But more or less, this is our setup and the evolution that we had over this last, I would say, 15 years.
Thank you, Davide. Very, articulated, I would say, path, and also in terms of actions and also, in terms of instruments. Joe, please. UK.
Thank you very much. Can you hear me okay? Brilliant. Well, look, I'd like to echo what Davide was saying about how valuable this work has been, and it's been a great pleasure to be part of it. and I think really useful lessons for us and future generations of cash managers. So going back to the wonderful slide that that Anthony put up about the funding instrument mix and investing mix and how that relates to the cash buffer. I think the UK is a good example to bring to life one far extreme of that, because we're very much in the full-on market access mode. Now, the background to that is that the UK's cash management approach changed really fundamentally in 2000, following a decision by a previous government to make the central bank independent for monetary policy purposes. Before 2000, cash management for the government wasn't really undertaken so much as fully integrated into monetary policy. So the cash flows would just arise, wash into the Treasury single account at the central bank, and have to be taken into account in monetary policy operations. That was obviously a constraint for a central bank that was now newly becoming independent for monetary policy operations, and created limitations on the sort of scope that it had to develop monetary policy approach. So a new cash management framework was evolved, and we went through an extensive process, including of public consultation on that, and it had the following sort of key points that were drivers for it. First of all, efficiency was thought best to put together cash management with debt management. They achieve economies of scale. It means that you've got bringing your expertise together into one operation, and obviously would also facilitate redemption management for public debt issues. The second one was this policy objective, which was very much about separating out cash management from monetary policy implementation, and required, therefore, a solution that was completely market-based, with the DMO as cash manager for government now transacting directly with private sector counterparties in the money market every day to actively offset the net government flow with the private sector. And that would allow monetary policy operations to be completely neutral to that. And the consequence of that would exhibit itself by the size and variability of government's balance at the central bank remaining very stable. Then we had to think about the nature of government's cash needs. So in the UK, we have strong seasonal fluctuations in the government's net cash position, which can go through periods of being very much in surplus and other periods of being very much in a cash raising need. And we were able to make use of the Treasury bill instrument for this. So we have a Treasury bill program which issues across benchmark maturities, but rather than separating out into having a separate cash management bill, we just integrate the need to manage the bulk of the seasonal fluctuations by varying the
Joe, you have been suddenly muted. Okay, perfect. Now, okay.
Brilliant.
It's not censorship. Okay.
No, not at all. I think you probably heard me up to talking about Treasury bills, so I'll pick up from there. Secondly, we were having a close look at the nature of the sterling money market. There's very good liquidity in the market, and in particular, luckily, we enjoy good liquidity in the repo market, both repo and reverse repo. And it's a very flexible tool, particularly for very short-term changes in the cash position. And in the spirit of trying to be very efficient about how we went about this, we created a collateral pool for the Debt Management Office to use to draw on. So there's provision for government bonds, UK government bonds, to be issued to the UK Debt Management Office, which can be used only for collateral purposes. And that means that we have a very ready supply of virtual liquidity. And finally, we had to think about the government's risk appetite. Was obviously going to be more risk because by nature of the solution, we were having to be active in the market, both on the investing and the financing side. So there would inevitably be counterparty risk. We also had to think about issuer risk, where we would be investing the surpluses. But there was a very clear steer in terms of the risk appetite. So we have no foreign exchange risk at all. Counterparty and issuer risk are kept as low as is practical given the cash needs. And in terms of the limits which assure that we've got adequate but not excessive advance action to manage the cash position that is projected, we have a mixture of liquidity and interest rate limits that help that. We also have limits which help control our operational risk. And so that's all enshrined in our objective today. We had a few updates as a result of the global financial crisis, which is obviously a very busy time for cash managers as well as debt managers. And a particular UK thing there, which I'd like to mention, is because we were operating regularly in the repo market, we were able, by being given some access to the central bank's quantitative easing portfolio, to recycle some of that collateral into the repo market. And that is aiming to help support market efficiency. As we observed during the QE era, a lot of tensions in the bond market were arising because of scarcity of those bonds, and that was exacerbated where there was some lack of recycling in the collateral market. And then finally, in the pandemic, again, a very busy period for cash managers, as alluded to by my other colleagues. And there we were able to establish a contingency arrangement involving the possibility to draw on funds at the central bank. So those are the two main novelties. Thank you. Hope that's given you a bit of a flavor.
Thank you very much, Alex.
Thank you. Thank you for the invitation to participate in the panel today. Obviously a phenomenal body of work. So before I get started, just wanted to take a moment to note the essential contribution of Caitlin McRae from the Bank of Canada for her contribution to this report. Her team of cash managers are great partners to the Government of Canada in their fiscal agent role. Broadly speaking, cash management for the Government of Canada has been conducted with an eye on prudence, flexibility, and taking account of the times. As we'll see, and it was mentioned by Anthony, technological enhancements, global influences, and monetary implementation can all influence the approach to cash management and the frameworks around it. The government has always managed cash balances with a buffer to ensure flexibility, while also taking a more active approach to investing its excess cash balances, the form of which has evolved over the years and has been a point of more frequent change. For example, from 1989 to 1999, part of the government's cash management buffer was lent out via weekly auctions to direct clearers of the payment system. These auctions increased to twice daily in February 1999 with the electronification of Canada's payment system. The auctions allowed the government to earn a competitive rate of return on its excess cash balances, while also helping to manage volatility of government cash balances. These auctions continue today, and they're known as the Morning Receiver General Auctions. Auction amounts and results are published daily and can be found on the Bank of Canada website. The Morning Receiver General Auctions were temporarily paused in March of 2020 due to the lack of participation following the introduction of the floor system for monetary policy implementation by the Bank of Canada. The auctions were reintroduced in 2024, and this reintroduction was motivated by the identification of an opportunity for the government to earn returns on excess cash balances given the prevailing market conditions. More broadly, cash management of the Government of Canada has had a major evolution with the current iteration of the Prudential Liquidity Plan, which was fully implemented in 2013 and continues to guide how we think about liquidity today. For simplicity, I'll refer to this as the plan throughout my remarks today. The current plan was introduced as being in alignment with the then proposed liquidity coverage rules under Basel III. In terms of context, we have to keep in mind that the great financial crisis and the turbulence in the European debt markets would have been fresh in the minds of policymakers. Additionally, this was a period where deficits and debt charges were coming down from highs experienced in the 1990s in Canada. This allowed more flexibility with respect to the government in managing its cash balances. Finally, as for all cash managers, and it has been mentioned by others this morning, COVID was a period of strain on cash management systems, and some internal metrics were adjusted to ensure appropriate buffers were maintained. Coming out of the pandemic, those internal metrics have been right-sized. Now to switch gears to the advantages and challenges of our structure, we feel that one of the advantages of the system is the level of communication that we have on payments between government departments and cash managers regarding one-time or non-recurring payments. This helps to ensure that treasury managers have the most up-to-date information for their forecasts and can ensure sufficient funds are available to make payments. In addition, the ability to lend out excess government cash balances via the morning receiver general auctions, assuming meaningful utilization, is a key treasury management tool used to reduce the volatility in government cash balances. Some of our challenges are not unique to Canada, such as seasonal fluctuations, unexpected flows, and increasingly large government security maturities that go hand in hand with a larger debt stock. When we think about volatility of receiver general balances, the fact that available balances are not always taken up by those daily auctions also presents some challenges. That's all I have prepared. Thank you. Back to you, Carmine.
Thank you, Alexander. So, in a sense, different experiences. We said one size does not fit all, but I would say good cash management, not one size, but fit for all, with different, again, experiences and opportunities. One thing, Davide, to you, let's have a quicker bit, 2-3 minutes each, the second round before closing. I mean, you mentioned, but also Joe mentioned explicitly the importance of repo, but actually also given also the size of the amounts of the debt, but also of the cash and the liquidity you may have. So what are maybe the different, instruments that Italy use, but in a sense, how you select these and in a sense, a trade-off between, them and so the results achieved. Also, I hear a lot that in terms also, let's say, of returns, it can be quite interesting. Davide, please.
Yes, thank you, Carmine. I should have done answering the first question. Actually, let me also thank the team of the Italian Treasury that worked on this project, the cash management, the people that work on our cash management, headed by Alessandro Iacono, who also contributed in the organization of the work regarding this publication. So to get back to your question, which is of course very interesting. Well, so in terms of instruments, I mean, right now as I said, on the liability side, we still rely even if with a different role on T-bills, on several standard maturities and commercial papers. But as I said, repo is now a crucial instrument, and we raise cash with repo on different maturities, even if we know that the most liquid part of the market is made of maturities up to 1 week. And in fact, we use it quite extensively also on an overnight basis. But there is also some liquidity also on longer maturities. But if you want, these is one of the constraints that we have on this kind of market. And this is another reason why we're also working on building bilateral repo activity, which we haven't started so far, but we are working on the documentation aspect on that in order to be able to start also with the bilateral repo. And now, of course, we have bilateral deposits that we carry out, as I said, OTC or through platform, to raise cash. On the asset side, instead, we have, of course, the reverse repo on this platform. But even on that case, we will try to move also on bilateral reverse repos. And then we have these bilateral deposits, OTC or on a platform. Now, in terms of the choices, of course, the choices depends very much on the size of the cash that we have to invest on, we have to raise. And so for different type of sites, there are different type of instruments. It depends, of course, on the market environment. It has been quite drastically changing over these last 10 or 15 years. There's also an issue regarding the spread of rates that we can get between collateralized and uncollateralized instruments. This, of course, the spread tend to widen or tightening, and so this is an aspect that we have to look at. And of course, another important aspect are the risk limits that we have with our counterparts, because of course this is another constraint. So in terms, you were asking me about the results, where I would say, first of all, we have an increasing number of now, thanks to all these instruments, an increasing number of money market counterparts. We have now almost 30 counterparts, compared to the fact that 2 years ago we just have 10 of them. And so these, of course, tend to improve competition and the efficiency of our cash management. We were able, I think, to improve in terms of efficiency of this cash secondary market of our bonds, because with the repo facility, especially when it comes to the repo facility, we raise cash and we give bonds to the market. And so the number of squeezes or distortions has been reduced quite significantly. So I think with our activity, we provide some contribution to that. We stabilized and lowered the treasury cash balance more and more. And if you want to have a little bit of numbers, I mean, in terms of pure efficiency, I mean, if I look at our cash balance, I would say that just taking 2024, we were able to achieve something like 30 basis points of yield above the remuneration we got on normal keeping the cash at the central bank. I mean, that is an average performance. Whereas instead, if I look at the uncollateralized deposit activity that with which we also invest cash in the market, we were able to, gauge something something in the region of 40 basis points above the remuneration we will got at the central bank. Last but not least, I would also mention the fact that offering this liquidity in the market with our money market counterparts, it also helped somehow the banking system, the liquidity condition of our banking system, but in periods of quantitative tightening or tensions in the repo market, having a sort of provider of liquidity in some sides, in some period, it can be really of help. So I would say different kind of results under different perspectives, but definitely there's room to further improve.
Thank you, Davide. You mentioned that this is for Joe, among the many things, also the size, obviously, the amount then of cash. And so, I mean, cash flow forecasting is an essential issue also to plan operation and getting also most efficient results. So, Joe, and this implies obviously a lot also of coordination among different, I would say, institutions. So maybe, Joe, the experience on that from the UK side.
Thank you so much, Carmine. Absolutely, this is a really important area, so I'm very pleased to comment on this. So the UK, like everybody else that has participated in the survey, has a cash forecasting architecture which is built around the Treasury single account. All of our government departments are mandated by a standing instruction to operate consistently with this. There's a very, very large number of individual departmental accounts, but they're all linked together in the system. And it means that at the end of each day, these accounts are automatically swept into a single account, netting them all off one against another. Those individual accounts are held with private sector banks, and there's a procurement cycle from time to time that allows, very competitive service provision for that. But the ultimate account that they sweep into is held at the central bank for maximum security. So associated with this system and the standing instructions that encourage departments to do it in that way is an incentive structure. So our Ministry of Finance, the Treasury, oversee regular monitoring, feedback. They set targets and they feed back to departments how well they've performed in relation to their cash forecasting. And that mechanism of using incentives to promote greater cash forecasting quality is a really important one and has performed really well. In terms of harnessing all of the information that comes in from the many departments and agencies that are participating in this swept Treasury single account, colleagues on the forecasting side do use data science techniques to try and support this very complex process and look at trends and patterns. It's a very important consideration when you're doing the cash forecasting is how far you can rely on historical patterns of the different cash flows. And I think a live example of that is where we have innovations in banking services, just generally in the economy, which is obviously a very good thing. It promotes wider efficiency and so on. But purely from a point of view of a cash forecaster, of course, any change is quite difficult to get your head around. And so that's an important challenge. In terms of the forecast rhythm, in the UK, we have an independent Office for Budget Responsibility, which is responsible for providing the official forecasts of government's overall cash financing requirement for the year. And that's from which we take our debt management remit. The process of updating the forecasts in the year from month to month, from week to week, from day to day, and including also updates during the day. That's carried out separately by the Treasury. I spoke in the previous question about the factors that lay behind the design of the framework in the UK and flagged market depth, market capacity, and the policy objectives as really key there and in terms of shaping the liquidity risk parameters. But I think it's really important to emphasize how much the nature of the forecast is an important factor in calibrating any liquidity risk settings. So in the UK, we have primary liquidity limit, which is about focusing on the start of day imbalance for the next business day and trying to make sure that that stays within a manageable range. That means manageable not just from market capacity point of view, but also taking account of forecast volatility and outright forecast error. And then finally, I just add that where we are calibrating the facilities that we rely on at the end of day, so these are very much contingency facilities, we have to make good use of historical analysis and scenario analysis to think about the ways to optimize that and calibrate that correctly. Thank you.
Thank you, Joe. Alexander, last word to you. Obviously, whatever you can plan, you can have a perfect forecast. Then there are also events, sudden events with so urgent liquidity needs due to also unforeseen, cyber attacks, disaster, and so on. So, what is, for Canada, but this has been adopted in many OECD countries, cash buffer policies, and what is your experience also in connection with the Canada Prudential Liquidity Policy? Alex.
Thank you. The audience will see that box 3.6 of the report speaks eloquently to this question. So this goes to the Prudential Liquidity Plan. In its current form, was introduced in Budget 2011 to protect the government's ability to meet payment obligations in situations where normal access to funding markets may be disrupted or delayed. As I mentioned previously, the plan was fully implemented in 2013. The objective here is for the government to be able to fund 23 business days of projected cash flows, including coupon payments and debt refinancing needs. The target is forward-looking and varies based on the projected cash management needs over that 23-day horizon. The financial assets that make up the cash buffer can be grouped into two categories: domestic cash deposits and foreign reserve assets. For cash deposits, we have a $20 billion callable demand deposit held at the Bank of Canada. Short-term deposits also held at the Bank of Canada for operational purchases, and then amounts held at other financial institutions via the receiver general auctions. I like to think of the plan as being a strategic component of the cash portfolio, and the day-to-day or tactical management of the portfolio is delegated to the cash managers. Positions are reported daily to internal stakeholders, and there's a high degree of transparency to the process including to the public where cash balances are reported weekly via the Bank of Canada website. Cash managers receive a forecast from federal departments on large scheduled items at the start of each month. And for one-off or non-recurring items, there is an expectation, as I noted previously, that multiple day advance notice will be given. Depending on the environment at any given point, internal buffers for cash managers can be adjusted, and that's really the flex in the system with respect to cash management and that buffer. An example of a tool that's available to implement the discretion that is delegated to the treasury managers are cash management bills. And these instruments are discussed in box 4.1 of the report and provide a tool for cash managers to enhance flexibility. In summary, we have a strategic starting point that is well understood, delegated implementation authority, and a series of tools to allow cash managers to be nimble in their approach. Thank you.
Thank you, Alexander. We are about to close, but Anthony, please, maybe for some closing comments, or what is also maybe a reflection on the project as a whole.
Thank you. I hope everyone listening has found and watching has found today's discussion interesting. I think it's brought out our main point that there's no one prescriptive answer as to how a sovereign should manage their short-term funding needs or cash balances. We've tried today to give an overview of the report and the factors that drive decisions that apply in Canada, Italy, and the UK, and how they evolved and are evolving. I think the report itself goes much further than what was said today in our presentations and reflects the detailed contributions of 22 countries and is greatly enriched by their shared experiences. During our meetings and in the report, countries have shared the factors that drive their cash balances, their short-term issuance, and the tools they use and the constraints they work under. I must express personally my thanks to all who so openly contributed. As David has said, it involved considerable work. The report now shares those experiences and insights with a wider audience. I'm sure any debt agency reading it will find something new to consider. As Carmine said at the beginning, there's not been a similar piece of work done before in this area, and certainly not one done where so many people involved in managing government cash shared their personal and practical experience. I'm delighted that the report is now there for others to gain from our shared knowledge. It's not the final word on the topic and does not seek to be. It does aim, and I think succeeds, in developing knowledge in this important area. And with that, I'll hand back to you.
Thank you very much, Anthony. I would say not just for your words today, but also for your, leadership of the ad hoc group that actually has been instrumental to produce the report in the last 14 months. And also, I would say, for your continued vice chairship of the Working Party. Thanks, Davide, Joe, and Alex, again, and not just for your role today and your words, but also for your really important, critical role you have played in steering the project. Thanks to all of you online, and still you are many, so the resilience is there. I hope you found this interesting. I know I have, at least for me, I find very interesting, food for thought. I hope also you got some, a curiosity to read, because again, it's very rich and all the details. This covers, the topic in a comprehensive, manner that I don't think has ever been seen before. So it's now available for downloading, and is on the OECD website. So share it also with your network. It's not a confidential document, and it's a network externalities I think we should spread. Just before we finish, and we are basically on time, which is we are still on time, which is always a challenge with two talkative Italians. And a few dates. So on March 20, we will be launching actually the 2025 edition of our global debt report on a sovereign and corporate bond, with also a focus on MDs markets. So there will be a launch event. So keep an eye also out for more details on that. We also have the 2025 edition of the OECD Global Forum on Public Debt Management, and this will take place in Paris on Tuesday 9 and Wednesday 10th of September. So also we have our forecast and we have to keep the planning. So we give you dates in advance. The Global Forum basically is a roundtable meeting for public debt managers from the OECD area, as well as regulators, central bankers, other financial policymakers, and on occasion also private sector participants. So the idea again is to share knowledge. This is also what the OECD for, and meetings with the counterparties also from non-OECD countries. So with that, really, thank you very much again for attending. Again, the speakers. Hope you all enjoy, reading our report, and wish you a very pleasant evening, morning, or good night for those who are in Asia. So thank you very much, and see you soon.